Thank you. Welcome to everyone. This is a fantastic event that you're about to hear. We are so delighted to have Ron here. We've got a lot of information we're going to share. My name is Cora Fulmore. I am the president of Diversified Resource Network. And again, thank you for being here. We're excited for having you here. And at this point, I'll turn it over to Latanya Gonzalez. Latanya?
Thank you, Cora. Hi, everybody. I'm Latanya Gonzalez. I'm with Freddie Mac, a secondary mortgage company that does more than purchase loans from the primary market. We also provide financial capability information in the form of Credit Smart. Tonight, I want you guys to sit back and get ready for all of the information that you are going to hear on tax preparation. Freddie Mac is so happy to be on board with this wealth building series that is empowering more consumers to get control of their finances. At this time, I want to turn it over to our fearless leader, Herman Palmer at NFCC. Thank you.
Thank you, Latanya. Thank you very much, and good evening. Welcome to this evening's presentation on tax preparation and planning. This is part of the National Foundation for Credit Counseling's Faith-Based Alliance Economic Empowerment Series. I want to start by thanking the Planning Committee, our presenter, our sponsors. And our sponsors are Freddie Mac, the Wells Fargo Foundation, TD Bank, and I want to thank you, our listening audience. As you've heard, my name is Herman Palmer, and I am the Vice President of Outreach and Inclusion for the National Foundation for Credit Counseling. Before we get started, I want to tell you a little bit about our organization and our mission. Our mission is to empower consumers to address their financial challenges so that they can take charge of their financial futures. We are focused on delivering better solutions. We have close to 300 member offices serving all 50 states, Washington, D.C., and Puerto Rico, and over 50 member agencies with over 1,100 certified counselors ready, willing to help people. We help everybody. We help multicultural communities of color. We help military families and veterans. We help small business owners and student loan borrowers, just to name a few. Okay, so now I'm gonna get into what we do. We provide general financial counseling, housing counseling, which includes pre-purchase counseling, foreclosure and eviction prevention, and reverse mortgage counseling. Small business owner coaching. We do student loan counseling and bankruptcy counseling. And I know bankruptcy has a stigma with it, but there are some solutions sometimes when bankruptcy is the best solution. And what our counselors do is they help to navigate so that that solution doesn't have to be as traumatic as the stigma suggests. So now we're excited about this presentation because it's a very timely subject, tax preparation. Yes, Uncle Sam and Aunt Iris are looking for you. And if I'm honest, it's a subject that none of us really wants to discuss because it deals with us giving up some of our hard-earned money. I know when I look at my paycheck and I see FICA, I'm like, who is FICA? Where does he live? Because he's taking too much of my money. Well, how about this? What if there was a way for you to develop a strategy that would minimize or mitigate how much you give the government legally? What if you could tap into a subject matter expert who could help you navigate those waters so that you could do it with confidence, you could do it correctly, and you could do it where maybe you don't owe the government. Maybe the government owes you. That's what this is about. Sometimes what you don't know can hurt you, but absolutely, sometimes what you don't know can wind up costing you money. That's what we're here to do today, is to connect you with the insights that are provided by a subject matter expert. And before I get started, there are some rules. This is a safe space. And by that, I mean, there are no silly questions. We expect you to ask questions. That's what you're here for. Chances are, if you have a question, several other people have the same question. And oftentimes, people are so shy that they don't ask their question. Several people have the same one, and nobody gets the answers they need. So what we ask you to do is put your questions in the Q&A box. It's on my computer, it's at the top. Just go in there. We will be monitoring it, and we will make sure that we get Ron the question so that he can answer it and you can get the information you're trying to see. All right, so ask your questions. Now, with that done, it is my pleasure to introduce to you this evening's presenter. Ronald Williford is the CEO and founder of Philadelphia Financial Consultants, LLC, an independent financial planning brokerage specializing in personal financial planning, retirement planning, small business consulting, and tax planning. He is a featured speaker on various financial topics and hosts the TV program, Let's Talk Money, which is exactly what we're going to do this evening. He has over 38 years of experience in the financial services industry in multiple positions. In addition, he is an experienced executive with a demonstrated history of working in the financial services industry. Ron earned his bachelor's degree in economics from Villanova University. He is active in his community. Currently, he serves on the boards of the Haverford YMCA, the Retired Senior Volunteer Program, RSVP, the NAACP PA State Conference Treasurer. It's good that you work with money, sir. The Business Center, President of the Board, and Fellows, Inc. He's the Vice Chairman. You're a busy brother. Ron is also a trustee at Enon Tabernacle Baptist Church in Philadelphia and is active in the financial and educational support ministries. Please join me in welcoming Mr. Ronald Williford. Ronald, I turn the floor over to you, sir. Please teach the people.
Thank you, Herman, for that gracious welcome, and welcome everyone this evening. Hopefully I'm going to be able to help you navigate through this thing that we call the tax system. So if I can just move to the first slide, and I would always, when I like to talk to folks, I like to quote some scripture. This is Proverbs 19 verses 20 to 21. Listen to advice and accept instruction, and in the end you will be wise. Many are the plans of a man's heart, but it is the Lord's purpose that prevails. So we can just move right to the next slide. I can get things going. So here we go. Most of us, the first thing you need to understand is how money flows. About 20 years ago, Robert Kiyosaki wrote a book called Rich Dad, Poor Dad, but his follow-up book was called The Cash Flow Quadrant. So if you look at this chart, you'll see that as an employee, everything's done for you. Your employer is going to deduct your income tax. They're going to pay your insurances. They're going to pay Social Security. They're going to pay FICA. They're going to take all that into consideration. And so you just work and then everything's taken care of. Or you're self-employed. As a self-employed person, you're an independent contractor. You get paid the money at the end of the year. You got to figure out what your tax bracket is or what you have to pay Uncle Sam. During the course of the year, you can opt to pay quarterly taxes to kind of alleviate the problem, but pretty much you're all on your own and you're taking care of your taxes by yourself. Or you're a business owner. As a business owner, you own the business, you have employees, same scenario, your money's deducted from your paycheck, and there's pretty much not a worry on how you're going to pay Uncle Sam. There's some strategies you can have that will help you. Or you're an investor. As an investor, you're receiving maybe dividends, capital gains, and some other sources of income in which you would have to determine once again how you're going to pay Uncle Sam. So during the course of this conversation, I'm going to talk about some strategies and also some ways that you can pre-plan so that at the end of the year, the tax bill isn't going to be that great. So we just move to the next slide. So most of them have heard of brackets, different income brackets. First, you need to understand, you may have heard the word marginal tax bracket. So up to the first 10,000 of income, if you're single, there's no taxes. So the zero taxes, you're on the 10% tax bracket. If you're married filing joint, it's up to 20,000. So you'll hear folks say, well, do I need to pay taxes? Typically, if you make less than this amount of money, you really don't have to file taxes because it's pretty much going to be a wash. However, if you're receiving if you had taxes withheld, you would receive a refund. Also, you may qualify for the earned income credit, which I'll talk about a little bit later. So we can just move right along here. So right now there are 5 filing strategies. You can be single, married filing jointly, married filing single, head of household, or you can be a qualifying surviving spouse, and you get some additional benefit from that. Now, it used to be that a few years ago, you could file single, you'd have 0 exemptions, 1 exemption, 2 exemptions, or one of the other categories. Back during the Secure Act of 2019, that all changed. So now you just have these brackets, and according to the IRS, they're going to determine the amount that you have withheld. So if you were never changed your W-4 since that time, you're set up on the old system. So that's the first thing you want to do. And I'll show you some ways that you can go in and adjust your W-4 and your withholding. What happened is that with that adjustment and with that change, a few years ago, some of us may have owed right away because of the difference in the tax structure. So it's always good to go in, I would say at least once a year, check your W-4. The other thing is if you have a multiple of jobs, and when you combine the income, you run into a situation where you will probably owe because each employer is considering that's the only income that you have available. So they'll withhold according to that one occupation. So we move to the next slide. So this is the withholding certificate. If you're familiar with this document, this is the first step that you need to do in order to make sure that you're having the proper withholding from your paycheck. As you can see, you see the different classifications: single, married filing separately, which are the same category, married filing joint, and qualifying widower, and then head of household. What I typically recommend, the IRS has a website, and it's the IRS Tax Withholding Estimator. I'd recommend that you go there probably now and take a look at that, because there's going to be a base amount that's going to come out of your paycheck. And if you use this tool, it will tell you if you'll break even or if you'll actually get a refund. So it's a good exercise to take a look at this tool during some course of the year so that you're in the right position next year. This year, you're pretty much set. I mean, there's some ways that you can reduce your tax bill after the fact, but pretty much during the year that you're working is the best time to plan and do things accordingly. So when you move to the next slide. So this is your typical W-2 that you'll receive, wages, federal tax, and you'll see a difference in your wages versus your Social Security wages. And that's because this particular person is contributing to a 401k or a 403b. Then there's different codes that direct you, and you're paying for insurance. Now, this is your federal withholding, and these numbers may be different according to what you're paying for or contributing to your 401k. If you take the $1,500, add it back into the $48,500, that's where you get the $50,000. Then DD is insurance. Then there's some other deductions from your W-2. Then here's checked off retirement plan. You actually get a credit if you contributed to your retirement plan. And then the state you're in. So happens I'm in Pennsylvania, so I used our lovely state for this illustration. So a lot of this, the taxes withheld, that is actually going to be a part of your itemized deduction, which, as I move along, I'll be able to explain that to you. So moving right along. Now, the biggest thing that we run into is that we have some retirees that are receiving Social Security. Back in 1983, a legislation was passed that a portion of your Social Security would be taxed. So if you're married filing jointly, if you make over $32,000, if you make less than $32,000, then Social Security isn't taxed. If you're a single taxpayer or head of household, you make less than 25,000, then Social Security is tax-free. So as you make more money and your income creeps over to 32,000, Social Security now becomes taxed. So if you look at this chart, Social Security can be taxed up to 85%. So what happens a lot of times is if you're receiving Social Security, you haven't withheld for Social Security, no withholding taxes. So when you do your income tax return, a portion of your Social Security does become taxed, and that may create an issue as well, or a problem. But Social Security does allow you to withhold up to 22% of your Social Security payment. So that can help you to alleviate going forward how much you'll owe for Social Security. So that's one of the biggest issues that I run into with retirees. And income is retirement income, what we call ordinary income. You could be receiving rental income. Any type of income that you receive is going to cause Social Security to be taxed. So that's another issue that you have to be careful of as you move along with your retirement. Next slide, please.
I got one question. Can we go back to that one?
Sure.
So Ron, let me ask you something. So looking at this, I'm looking married filing jointly,
right,
versus a married couple filing separately. It looks like personal income amounts. It looks like you make out better. What do you make out better? Should a retired person? So in a scenario where if it's apples to apples, it's the same couple, and they have the option to file jointly or file separately.
Right.
Where do they get the biggest break?
Well, it depends on the situation, actually, because when you file married separately, you lose some of the other credits.
Okay.
So I always, there's no clear-cut answer. Everybody's situation is different. So what I do it two ways, with and without, to see whatever the best scenario is. For example, if you file, let's say you had interest income from your student loan. If you filed married filing separate, then you can't claim that credit or deduction. Okay. So it depends. I don't think there's any clear-cut answer.
All right, and then I saw that there was a question that came up in the chat, well, there was a question somewhere. It said, Ron, is your Social Security still taxed if you're older than 65?
It's taxed as long as you have that income, it's still going to be taxed. Now, if you're not the normal retirement age, if you're receiving Social Security, you can only make a certain amount of money. But once I think for this year, it's 22,000. So if you make over 22,000 and you're receiving the early benefit, then your Social Security will be reduced. However, Social Security will be taxed unless the laws change, as long as you're receiving it.
And did I hear you say, I got my Social Security income that I put into,
right,
and then it's going to get taxed? 22% of it gets taxed?
No, what you can do, you can withhold up to 22%, but 85% is included as a part of your taxable income.
Isn't that special?
Yeah, I mean, that's a big hit. That was back in the early 80s when Ronald Reagan was president. He decided that we want to tax Social Security.
The great communicator.
Right. So you actually paid tax when you paid something into it. Now you're getting hit again, and that's ordinary.
That's double dipping.
Right.
Wow.
And then at age 72, you have to take your required distribution from all pension plans. You can kind of skirt it up to age 72. Then at 72, you have to take your required minimum distribution.
And if you don't, they take $1 for they take a certain amount back, correct?
Yes, 50% of whatever you were supposed to pay.
Wow. Okay.
So you get penalized if you don't take it as well.
All right, I'm sorry, I didn't mean to interrupt. I just, I'm trying to show people you can ask questions.
Okay. Any other questions before I move forward?
We have one that said, did you just say 50%?
Yeah, if you're with your required minimum distribution, if you don't take it, you'll receive a penalty up to 50% of what you should have taken. So it's a big hit. Yes,
Is that
5-0.
Yep.
Like half, like Eddie Murphy said, half.
Yeah. And you don't even have to be married to the government. But go ahead.
Now, the next, I talked about self-employment income. So the way that you report your self-employment income, if you're a sole proprietor, or you receive some 1099 income, you'd have to do a Schedule C. So it's your revenue minus your expenses, and whatever's left, you would pay taxes on that amount. Now, the big thing with being a sole proprietor or self-employed is that you have what's called a self-employed tax. So whatever your net profit is, you're going to pay up to 17% of that money. And that takes care of your self-employed. That's what takes care of Social Security and FICA, the health insurance. Now, the government gives you credit back of 7.5%. So the net cost of you is 7.5% on your self-employed income. And all of this flows back onto your regular 1040 form. And a lot of folks don't understand how that works as well. If you're self-employed, that's why if you receive a 1099, it's called a 1099 NEC. You receive that, that's self-employed income. And if you don't take any or declare any expenses, that number is then additionally taxed 17%. So that's where a lot of folks run into issues as well. So we move to the next slide. Any questions?
Yeah, I do. This is not so much a question as it is an observation. Having been an entrepreneur myself, one thing people tend to do is they miss a number of opportunities because they don't have good record-keeping practices.
Correct.
You said that you get taxed on your revenue. I'm sorry, on your profits, not necessarily just your revenue. So you got to take your bills, your expenses, and take that from your revenue. And then the delta is your profits. And that's what you get taxed on. So many times people are in a rush to do the next thing, they lose receipts. You have to have good administration, good business practicing skills, such as having a file and being disciplined to keep those receipts so that you don't lose out on deductions. I just want to make that point.
Right. I mean, you should have some type of financial software or like you say, some type of accounting system. I mean, we've heard of QuickBooks, there's some other systems out there that you should be using if you're receiving self-employed income.
And it's better to do it every day or every week than wait until it's tax time. And then you got to try to remember stuff that you are not going to have a shot at remembering all the details. So do it every day, put it in a little envelope, file it away, and then organize it on the weekend. It makes your life so much easier. I'm sorry.
Right now, then there's automated systems that are good as well. Mile trackers, one of the biggest deductions if you are self-employed is your business miles. It's almost 60. I mean, the end of last year was 62%, 62 cents. So for every 1,000 miles you earn, you cut 60% of that you'd be able to write off. Next slide. And this is the old 1040. I think what has happened in our society, the tax preparation business has become commoditized. So now you can go buy TurboTax and some other software, but I don't think the general public actually understands how the 1040 works. So, I mean, this is all the information, your filing status, name, address, social security number. Then you have your dependents. All that information goes on there. That's pretty standard information. And then you go here, there are actually two things that can help you with your tax return. You have deductions and you have credits. A lot of people get confused about deductions and credits. Deductions are a line item that comes before we calculate your adjusted gross, or the number that comes before you pay your taxes. It's the number that determines what you will have to pay. So we look here, you'll look at IRA distributions are here on the first page, wages, any dividends, interest, they're all considered income. And then also on this page are different ways that you can strategize. You'll see Social Security benefits. If you fit in the category where you don't know, that isn't carried over into your income. But if your wages and everything above that number are higher than the 32,000, if you're married, filing joint, then you'll see a portion of your, or up to 85% of your Social Security does become taxed. Now, there's two different ways. You have a standard deduction and you actually have an itemized deduction. Standard deduction, what has happened to our tax system is that the standard deduction has been increased. So right away, if you're single, your standard deduction is 13,000 and some change. In order to itemize, you've got to be above the standard deduction. So that's the first thing. That was the first big change that happened. If you're married, filing joint, now the itemized deduction, the standard deduction is 26,000. So in order to claim any itemized deductions, you have to have more than the standard deduction. So we could just flip to the next slide. So here's the explanation of the standard deductions. If you're single, the first $12,950 of your income, you wouldn't be able to claim the itemized deduction. So if you have mortgage interest, you have taxes, you have maybe some medical expenses, they all have to total over and above, if you're single, is $12,950. So that's where a lot of people lost the ability to use their itemized deductions. Or if you're married, filing joint, $25,900. So if we look at this chart, there's, depending on where your filing status is, the standard deduction has been increased, and then it's going to increase again in 2023. So it's made the tax system simplified. So if someone comes into me and, if I'm preparing their taxes, and as a single person, in most cases, a lot of people aren't itemizing their deductions anymore because of the increase in the standard deduction. The old tax system, the standard deduction was lower, so you'd be able to claim a lot more of your itemized deductions. One additional factor is if you had any employee expenses, you were able to, in the past, if you had to drive somewhere for your job, from your job to another location, you could claim those miles. That all changed in 2019 with the Secure Act. Only if you're in the military can you claim any employee expenses. You may have union dues, you may have work boots, you may have a bunch of stuff that you used to be able to claim, publications. You can no longer claim those as an employee. So the whole strategy of this business, of this system, is weighted towards someone that's in business, because as a business person, you can deduct all those items. Next slide. So if you look at the Schedule A, some of the deductions you can make. One of the common things is folks will collect their medical and dental expenses, but in order to claim your medical expenses, it has to be over 7.5% of your adjusted gross. And it's the first dollar after that. So if you made 100,000, that means you have to have at least 7,500 of medical expenses before you can claim the first dollar. The taxes you pay, it used to be no limit on the amount of taxes. So your state, local taxes, real estate taxes, and any other taxes that you were paid were able to be claimed on the Schedule A. Now that number has been capped to 10,000. So if you had a mortgage and you had taxes and, all that total was, let's say 12,000, you're going to be capped at 10,000. That's why a few years ago, many people were going out and paying their taxes in advance because this deduction was going to be, itemized deduction was going to go away. The interest you pay, and that's your mortgage interest, there's no cap on that contribution on how much you pay your mortgage interest. That's still, a number that's not capped. Then the gifts to charity, and then your casualties. Also, one note that's not on here is if you're a gambler, you can write off all your gambling winnings. You can write off the losses up to the amount that you want. So it's still a valid way to utilize the Schedule A. And, I compare both the standard deduction versus the Schedule A, whichever number is greatest, then that's carried over to your actual 1040 return. And it can help you in many respects to reduce your tax rate. So just move to the next slide. So we say, what's your adjusted gross income? That's usually it's the bottom sheet of the 1040. It's the number or your income that the federal government uses to determine what your tax liability is. So the first mechanism is to help to reduce your taxes. You look at your standard deduction, then you look at your itemized deductions, and whichever number is the greater will help to reduce your adjusted gross income. So on that first page of the 1040, you're working on a way to either utilize the standard deduction. In some cases, standard deduction will help you. In other cases, it won't. So, you're looking to balance the standard deduction versus the itemized deduction. And with the new tax laws, a lot of the itemized deductions have been eliminated. So it's tough to, in some cases, to get the itemized deduction because of the increase in the standard deduction. Next slide. So now we go to credits. We have various credits for additions to help you on the back end after you've determined your adjusted gross income. Some of the most common credits are dependent child care, child tax credit, earned income credit, education credits, and then adoption credits. Well, I'll go into more specifics on each one of the credits. Can you move to the next slide? So dependent child care credit. Back during COVID, a lot of this has changed. It used to be that you can claim up to 35% of your qualifying costs, up to $3,000 for one dependent, or $6,000 if you had two dependents or more. That all shifted during COVID. You could, during the pandemic, you were able to claim all your expenses for dependent child care. And that all changed with the current tax year. And, it's the Form 2441, dependent child care. You would need the name of the child care, Social Security number or tax ID number, and then the amount that you paid in child care expenses. That's one of the more popular credits, especially if you have children. And if you send your child to camp during the summer, that qualifies for the child and dependent care tax credit. And your child must be under 14 years old. Next slide. And this explains what the child tax credit is. It's a tax benefit granted for American taxpayers if you have a qualifying dependent child. And for this year, it's $2,000 per child. And it's not available it's only available for children under age 17. During the pandemic, they increased the child tax credit. If you were 6 and under, the actual credit was $3,600. From 6 to 17, it was at $3,000. What has happened this year is that credit has been reduced to $2,000 straight across the board. So if you were claiming children, or if you have children previously, you're going to see a change, and you're probably going to get less of a refund, or you may even owe, because now you're losing, in some cases, up to $1,600 if your child's under 6 of a tax credit. The question, yes, once a child is 18, that's it with the child tax credit. And if they have to turn, if they turn 18 before the end of the year, then that credit's not available. So that's going to be, if you have children, you'll see a significant change depending on the the amount of children that you have. That's $1,000 loss per child, and the $2,000 is the regular child credit. They enhanced it during COVID to try to put more money into everyone's pocketbook during that pandemic time, or during COVID. That's all been changed. Next slide.
We actually have a question from Cora. She asks, what's the situation if they are currently in school?
There's no child if they're in college, or if they're in college, they no longer the age for age 17, regardless of college, whatever, you would lose that child tax credit. If they're in college, there are some college credits that are available. You get, of course, still claim your child, but there are some American Opportunity credits and lifetime earning credits that are available.
So once they turn 18, they lose that
child tax credit is gone. Yeah.
Got it. All right.
Oh, you can still claim them on your taxes. You can claim anybody as long as you support them. Don't matter the age. Yeah, as long as you provide a substantial part of their economics, then you should be claimed. You can even claim your parents if you take care of your clients. I mean your parents, excuse me. Then we have the earned income credit. Actually, if you're single, you can actually receive an earned income credit, and that's based on your income. And you have no children. You make at least $7,300, but less than $9,160. You can earned income credit up to $560. So a lot of people think that the earned income credit is just if you have children, but you can actually be single and receive the earned income credit. The sweet spot for the earned income credit is right here. If you make between $15,000 and $20,000, you would hit the maximum earned income credit. That's what we call the sweet spot. And it's eliminated for income over $53,000. So there's some opportunities for the earned income credit. If you're married, filing jointly, same deal. No children. If you make less than a certain amount of money, you're gonna be able to qualify for the earned income credit. And then the chart, and typically with 3 or more children, the sweet spot's right here of $26,000. You can get up to almost $7,000 of an earned income credit. Now, you have two different types of credits. You have a refundable credit. You have a non-refundable credit. A refundable credit, and earned income is an automatic credit, meaning that there's no real qualification except for your income. In non-refundable credit, you have to be, if you owed, then that credit would be applied. So if you came to the tax bill and you owed money, then a non-refundable credit would be applied to help you offset what you would owe. Next slide. And this is the education credit. There are 2 types: the American Opportunity Credit, and that's for if you haven't exhausted your 4 years of college and you're single, the maximum income you can make is $90,000. If you're filing joint, the max is $180,000, and the child must be at least part-time, and they can't be convicted of any drug convictions. And it's for any qualified expense, tuition, enrollment, anything related to college. And what I typically recommend is if you do have a child in college, make sure you're claiming them. Some students, I come up with this idea that I'm the independent now. I'm going to file my own return. I mean, the credit doesn't really benefit them as much as it would the parent. And I've seen a lot of clients, the child has become sophisticated when got TurboTax, did their own taxes. They do their taxes because during the course of the year, the W-4 was set up to claim the child. Now you no longer claim your child. They've already done their taxes. So now it puts the parent in a situation where they could potentially, then we have the lifetime learning credit. It's not refundable. The income limits are the same. If you're single, 90,000. If you're married filing joint, you have to make less than 180. And student doesn't have to be in need pursuing a degree. You can go to just about anything related to lifetime learning. And you have to take at least one or more credits. So if you're out there taking some type of course, you may qualify for the lifetime learning credit. And it's a pretty decent credit to your bottom line. And it's added right to your list of credits. So, some folks miss this credit, especially the lifetime learning credit. So, like I said, if you have children in college, claim until they're finished because it's going to benefit you. It's going to benefit you more than it typically would them. Okay. Next slide. Then one other credit that's pretty significant is the adoption tax credit. It's up to $14,890 per child. And you can only use this credit if you have an income tax liability. This is one of those credits that if you did your taxes, I owe $5,000, this credit will help to offset you owing. So it's only a credit that is not refundable, which means you have to have a tax liability in order for this credit to kick in. So it's actually two different types of credits, refundable and not refundable. So, and then you go ahead.
That tax credit, the adoption tax credit, is that something that's done, you can do annually, or is that just in the year in which you adopt a child?
It's every year.
Okay.
Yeah. Yeah. Next slide. Now, in July of last year, the Inflation Reduction Act of 2022. A lot of people probably aren't even aware of this Reduction Act. What the government's trying to do is give you credit for being energy efficient and residential clean energy. So if you go buy a hot water heater and it's energy efficient, solar powered, then you're going to get a tax credit. So we're trying to, I guess, clean the environment up. So if you do that, it's going to give you some credits. Last year, if you took these energy credits, the max was $600. Going forward for 2023, that max is going to be $1,200. So if you were putting off that new insulation, putting off the solar panels, now's the time to go buy it because you're going to get a much greater credit this year. And also it lowers the cost of drug costs. You may have seen in the news where we're trying to control some of the cost of drugs. Well, this act is what helped to put that in place. And it's designed to help the super rich people in this country. So we kind of spread the tax bill a little more efficiently. Next slide. So here's some of the clean energy tax credits. The biggest thing is, if you have solar panels, there's some big discounts on the solar panels. You get like a 30% discount. Small scale wind energy. There's all these credits. Some are in effect right now. So if you find yourself in this category, make sure your tax preparer takes into consideration these credits. In 2023, which is this year, battery storage credit, up to 30% discount on the purchase, and the rooftop and community solar rebates, and then battery storage for nonprofits. So there's some additional credits that were put into effect now, then there's some that will be into effect in 2023. Next slide.
Pardon me, Ron, I have a question. Are there any other items included in this clean energy tax credits, such as home appliances or large purchases that might convert gas to electric use?
I'm not specific on that, but I'm sure, I mean, I could do the, you can do the research, but
Sure.
from what I understand, anything energy related, there's going to be some tax. Like, for example, you put in new windows and there's certain type of windows, you'll get a credit. So hot water heater, solar, everything solar, energy efficient would probably apply to this credit.
Thanks.
You're welcome. Next slide. Now, one of the biggest things is if you decide to buy a car this year, you might want to buy an electric vehicle. A part of the Inflation Reduction Act is centered around electric vehicles. So you can get up to $7,500 credit if you buy an electric vehicle or energy efficient vehicle. And the criteria is that it has to be less than $55,000, the amount of the vehicle. That's why you see Tesla reducing their prices in order to use this as an incentive for someone to buy a electric or clean vehicle. If it's used, you can get up to a $4,000 credit, and it's takes place as a discount at the dealer, and that's also as a credit on your tax return. If it's an SUV, it could be up to $80,000, regular car $50,000, and if it's used, the vehicle has to be less than $25,000. And if it's a new vehicle, the adjusted gross income has to be under $150,000 for a single person, $225,000 for a household, and if you're married, you have to have less than $300,000. Now, if it's a used vehicle for a single person, the adjusted gross has to be under $75,000. For a household, it has to be $112,500, and then if you're married, it's $150,000. So, looking to buy that new vehicle this year, you might want to lean towards a electric vehicle if it's in your budget. Next slide. Also, one of the key elements going forward is that if you're contributing to your 401ks, those numbers have been going up over the past few years. In 2021, the max you can put into your 401k or 403b or 457 was $19,500. This year it's $20,500. Beginning in 2023, you can max out at $22,500. Also, catch-up provision. If you're over age 50, you can add additional money up to the point where you can add an additional $30,000 into your 401k. And that's one place where you can actually reduce your taxable salary. And then the annual contribution limits, the amount of money you can make that's considered for a pension, has also been going up. So if you catch the notion, you can see that this whole bill is trying to increase the amount of money you can put away for retirement. And I guess so that when the RMD, you'll have more money you can give back to the government. Yes, for the 401k, you can put up to $30,000 if you're over age 50. $22,500 would be the normal limit. You can add an additional $7,500.
Oh, okay.
So up to $30,000.
I took it as the 22 plus an additional 30. I'm like, if I had an additional 30, I wouldn't need to be working. But okay.
No, it's 30 max, capped out at 30.
There we go. Okay. You brought me
and
back
then
to
also, then also the IRA contributions have gone up. In 2021, it was 6,000. 2022, 6,000, and beginning this year, 2023, it's 6,500. And if you're once again over age 50, you can add an additional 1,000 as a catch-up provision for an IRA account.
So let me ask you this, and this might be getting in the weeds, but you know, I've heard it said that the government has kind of been sneaky about how they want to get more of those retirement dollars, and so they're making you take out more of the retirement at an earlier rate, at an earlier age, in terms of, because the more you take out, the more they can tax.
Right.
Is that something that you've seen happening?
I think what I see happening is they're increasing the amounts that you can contribute. So in effect, they're taking less of a strain on Social Security. And what they've actually done, the RMD, the required minimum distribution,
that's it.
Is actually being pushed out. Before 2019, it was you had to take the required minimum distribution by age 70 and a half. Now it's age 72, and in legislation they're going to push that to age 74. So I think a part of the mission is to try to take less of a strain off of Social Security and try to give you more incentives to come out of your own pocket.
And so, and as they push it back, are they also increasing the amount?
Well, it's all based on the IRS table.
Okay.
So at age 74, the older you get, the more you got to take out.
Exactly.
Because based on you're going to have more money and you're going to be older, so the number you take out is going to be much greater.
And they're going to take more money. Okay. All right.
Right. So it's based on your life expectancy. So the closer you are to your life expectancy, the more money that has to come out of your retirement plan.
And then the other piece of it is, the older you are, depending upon your health, you might have to take it just to maintain a higher quality of health.
Exactly.
And so Cora said, asking, so would you suggest that you put your funds in an annuity or an IRA?
Well, see, the thing, an IRA can be an annuity.
Yeah.
The IRA is the individual retirement account, but you can pick any investment to be an IRA. You can actually purchase real estate and have it designated as your IRA, as long as you don't live in the property.
That's the investment vehicle where the vehicle in which you put your funds. Yeah.
Yeah. The IRA is the government term, but then you can use any investment vehicle, mutual fund, annuity, bank CD, bank savings account. You know, so yeah, the IRA is the common name. But I mean, annuities are good. I mean, all are good in my opinion. Next slide, please. So I was just going to tap on some of the business income taxes, because if you own a business, you're self-employed. If you're, let's say, for example, you have an S Corp, those taxes are due March 15th. So if you have a partnership, you're in a partnership with someone, that return has to be done next week. And then S Corp, and also if you have a corporation. Next slide. Then I just want to go over some of the legal structures of the business. So if you have a partnership, I mentioned you have to file what's called a 1065, and you would take the profits and split it, or losses and split it amongst your partners, and then each one of you would receive a K1 to share and report that percentage to your tax return. Next slide. Then we have a limited liability company. I think a lot of people sometimes get confused with what an LLC is. An LLC is a business where you're protecting your business from your personal assets. Now, within the LLC itself, you got to let the government know how you want to be taxed. You can be taxed as a sole proprietor, which you would complete a Schedule C. So that becomes a part of your regular return, and you pay the self-employment tax. If your LLC contains more than 2 members, then you actually have a partnership. So then you would have to file a partnership return, which is the Form 1065. Or you can be an LLC and ask the government, I want special treatment. I want to be treated as an S Corp. An S Corp in itself isn't an actual company. It's a classification from the IRS. So as an S Corp, you're going to be taxed. You'll see a lot of people with LLCs, they'll pay themselves a salary. If you're not designated as a S Corp, you theoretically can't pay yourself a salary. So you become an S Corp, you can pay yourself a salary, and you bypass the self-employment tax. So a lot of cases, if you're making a certain amount of money, you probably should start to look to become an S Corp as one way that you can save taxes, which that in itself could be another discussion at another time. The next slide, please.
Hey, Ron, before you go to the next
Yes.
one on the S Corps, if you have an LLC and you have not gotten any income, you haven't generated any income, do you have to file a tax return
Well,
for the LLC?
How long haven't you received any income?
For 1 year.
What I would do if you don't have any income, you definitely have some expenses.
Okay.
Yeah, I mean, worst case, you have expenses that you can offset some of your income.
Okay.
So you still want to file. Yeah, startup probably cost you something to form the LLC. You know, and I always say if you form an LLC, you start thinking business wise. So you may have had some meetings during the year that qualify for meals and entertainment. You may have had to purchase a PO box. You may have done there may be some expenses to establish the LLC. So, write off those expenses. But if
Thank you,
you
Ron.
But if you don't receive any income for several years and you always got a loss, the IRS may tap you and say, hey, this isn't a business, it's a hobby. So at
I
some
gotcha.
point, you got to start showing some profit. You may have let's say you might have a hobby shop, or you converted your hobby of collecting sports cards into a business, but you keep showing a loss. The IRS will come and say, okay, this is not a business. You haven't shown a profit in 3 years. This is a hobby, so they'll negate everything that you did previously. So you got to be careful of that as well. So an S Corp was simply, you can be an LLC, single member. You can ask the IRS that you want to be taxed as an S Corp. So if you're taxed as an S Corp, you right away eliminate that self-employment tax. And if you're a sole proprietor, that's one of the bigger taxes that you're paying. What the IRS says is that if you become an S Corp, you can pay yourself a salary that's considered reasonable compensation. And the reason they say that, because some folks will form an S Corp as a strategy to just totally eliminate the self-employment tax, but it has to be a fair amount of compensation that's comparable to someone doing the same job that you're doing. So if you run a daycare, you pay yourself a reasonable salary of what other daycare directors would pay themselves. And it's pass-through income. You take your net profits or your income, and it passes back to your regular individual return, but it passes in a different way, bypassing the self-employment tax. And it's not taxed at the corporate level. So it's another strategy that as your business grows, you might want to consider changing your status to an S Corp. Next slide. Then you have your regular corporation, C Corp. It takes the form of you as an individual, so that the corporation, it can be sued, it can own assets, you can loan and borrow money from a C Corp. So it's a whole different tax strategy. So one of the other avenues that you want to look at if you're a business owner is having your business set up the right way to be more efficient with the tax process. Next slide. Any questions? I think this is the place where I can really help you. If there's any questions, you know, I tailor make my presentation and I can kind of make it a little more user friendly at this point. So if there's any questions, I'll be glad to entertain those questions.
Oh yeah, I've been taking some notes and got a couple. So, and this is, you know, this is what you hear. You know, these are the urban legends. So, for example, like the later you file your taxes, the less likely you are to get audited. Is there any truth to that?
That's not true.
Okay, we can strike that off the list.
Now, one statistic that we found that African Americans are audited more frequently than any other social class.
Surprise, surprise, surprise. All right, and I'm not even on Goma pile. All right, here you go. If you make over a certain amount and your taxes are done by a professional, you're then less likely to be audited.
That the audit process is random, pretty much.
It's just the beat.
Yeah, at one point they were targeting small businesses if you made over 250,000. So it's pretty much a random process as to which who and what will get audited. But one thing I will tell you is that there are certain red flags that trigger audits. For example, in a lot of cases, if you're self-employed, people would use the mileage to kind of tweak the numbers. So they'll say, oh, I did 50,000 miles. And, you know, during the course of the year, that's a red flag. So they'll pull you in for that. Some of the other things are the earned income credit. You know, you're claiming kids that aren't yours. So they will look into that type of stuff. Because me as a professional preparer, I got to say that I'm aware of the children. I collect the Social Security cards. I collect identifying information to make sure that that is a qualified dependent.
Okay.
And, you know, because folks will go, because especially with, you know, people can go on and do their own return. I mean, you can manipulate the numbers.
Lottie, Dottie, everybody. Okay.
Right.
How long should you store your tax records or your records? Over how many years? I keep hearing. Sometimes I hear 7, sometimes I hear 10.
Well, the IRS will go back 3 years if they could pull your records. But if they think that you committed a fraud or were, you know, didn't properly prepare your returns, they can go back forever. There's no limitation for that.
Yeah, and okay, now in that scenario, what happens if you say 15 years ago, I don't have those records?
Knock, knock. IRS is here.
That's not good. Okay.
Yeah, I mean, your record keeping, I would say at least 3 years. Yeah. I mean, you get, and also the 3 years, you can amend any return 3 years. Now, what the IRS is also doing is if you were to receive a refund, and if you don't capture it within 3 years, they're not going to give it to you. Because, you know, a lot of people say, I'm not going to file, but you should, in some cases, you should just file because you might get a refund. Because billions of dollars go through the system that aren't claimed.
So they make all the rules. Okay.
Oh, yeah.
Yeah, okay.
And they're the only one that can shut you down, the IRS.
Yeah. Oh, yeah. How critical is it to work out a repayment plan as opposed to just you know you owe, and you just say, I'm just going to pay a specific amount every month. Is that a wash, or is that a problem?
Well, it depends on your budget. I mean, you know, in most cases, set up an installment plan. I mean, if you owe a substantial amount, they'll allow you 6-7 years to pay it back.
Okay.
But, you know, the IRS, as long as you communicate with them, there's no issues. When you ignore them is when you run into the situation. But you set up the installment plan. The only problem with the installment plan is the longer you take, there's penalties and there's interest. So, you know, if you understand compounded interest, that gets larger and larger.
Okay.
But there's one other thing, that if they can't capture the full amount within 10 years, they'll get rid of the debt.
They'll what?
They get rid of the debt. If it took you more than 10 years, but they're not going to tell you that. You'd have to go and say, hey, it's past 10 years, and they will. You still owe that. That's gone. If they can't get it within 10 years.
I don't want to have that conversation, but it's nice to know.
Yeah.
Thank you.
Yeah.
Okay. So now, how about stacking retirement stuff? So let's say you're working for a corporation. Let's say you have a landscaping business that's yours. Let's say you have a training business that's yours, and you have a barbershop. So you're working for a corporation, you got a 401k plan. Then you got an IRA for your landscaping business, and you can save up to a certain amount in your IRA. Then you got your whole barbershop business. You can save up. So you can basically increase the amount you save based upon the number of companies you have and the income you have associated with each organization. Correct?
There's an overall cap across the board of all, no matter what. There's an overall cap. So you can't max out this one, that one. There is a cap as to the amount that you can put.
Okay.
I mean, I have software and planning stuff that will tell you exactly the amount. Yeah, there is a cap. They're not going to let you max out everything. Remember, we're dealing with the IRS. There's no limitations. Affectionately
known as Aunt Iris.
Right.
Who's associated with Uncle Sam. It's just wonderful, my family. Those are my questions. Come on, people. Don't be shy. Remember, there are no silly or dumb questions. This is your opportunity to get them out, because guess what? It's tax time.
Yes.
Yay, us.
Herman, did you see Cora's questions?
I don't know. Cora, come on. Cora, you can speak. Come on.
Thank you so much. This has been really good, and I appreciate it so much, Ron. And Herman, thank you for bringing all of this to us. What about church contributions? Can they cause a red flag?
As long as they're legit, you have to get a statement from your church.
Okay.
Yeah, usually your church, because if they won't accept just checks, and most churches will give you statements for the amount that you contributed.
Okay. And can you avoid the penalty fees?
No. You mean as far as owing?
Yeah.
You would have to do what's called an offering compromise. If you owe so much that you can't pay, you can do an offering compromise, and you would list your assets, liabilities, and income, and they may soften the blow that way. But the penalties and interest, no. And like I said, it's always about how you communicate with the IRS. If you ignore it, then you got a problem. But as long as you communicate, they're willing to work something out with you. And B, you hear the commercials, we can do this and do that. In most cases, you'll be able to do that yourself. I wouldn't pay anybody to try to solve your issue, not unless you need an attorney. And if you need an attorney, you're in big trouble.
You just mentioned something that made me think about some advertisement that I've seen on television.
Optimist.
Okay.
That's the one.
Okay. Well, I don't want to call any names, but how do you feel about this advertisement?
I think that you could pretty much do it yourself. I mean,
Okay.
there's a form, it's called a offering compromise form. And you can actually go on the website, the IRS website, there's a questionnaire that see if you pre-qualify to even do the offering compromise.
Mm-hmm.
So I mean, there's too many other tools than to run off and pay someone to do it.
Mm-hmm.
About how much, do you know how they charge? I assume it's a percentage of the debt you owe that they recoup for themselves.
I'm not sure how they charge.
Okay.
I've never, to be honest, never dealt with them. If someone comes to me, I'll help them to complete the offering compromise.
Mm-hmm.
Because, you know, the thing is you pay that money, there's no guarantee that the debts are going to be eliminated.
Right.
You know, they're going to talk about who they helped, but who haven't you helped? And
Right.
what reasons
Right.
have you been able to? You know, so you always ask that question.
Mm-hmm. So, Ron, let me ask you a question. You just made me think about something. Most people are so afraid to pick up the phone and call the IRS. They think that they're all out to get them, and nobody's willing to listen to their complaint, problem, or concern. Is that really true?
No, I think with the way the internet is set up now, you can actually, there's a lot of tools from the IRS that help you. I think they're here to help you. And if you pursue the help, you know, they're willing to help you. And a lot of the strategy you can do yourself. I'm of the opinion I help folks. So, you know, I'll point you in the right direction. If you need me to get involved, of course, you know, I do this professionally. There would be a fee, a reasonable, you know, I'm not in this to make a living from it, but, you know, it's about helping people and steering them in the right direction. Because you can actually go to the IRS website and type help, and a whole bunch of stuff will come up.
Okay.
And I always recommend that, you know, in order to understand what the IRS is doing, go set up an account with the IRS.
Mm-hmm.
IRS.gov, and you can go in and see, like you have a bank account, you can have an IRS account and see the status of your returns and see if you owe anything, and, you know, there's letters or anything if there are any issues.
Okay, that's it for me. Thank you.
You're welcome.
So this is not so much, maybe it's kind of a question. So part of the reason why we've developed this series is to really help folk, regular folk in the community, to begin to think proactively about wealth building, about their financial outcome, improving those outcomes, about getting connected to resources. And so our previous session was on wills and estate planning. And as I think about how people can best prepare themselves for financial growth and well-being and wealth accumulation, it's like you need a board, an advisory board of subject matter experts who can collaborate with you and each other to your benefit. And as I'm looking at our schedule, as I'm listening and interacting with subject matter experts, it seems to me that you need to have an attorney, an accountant, an investment advisor, and an estate plan. Is there anything else that, as you look at the building blocks of real wealth, is there anything that I'm missing in that lineup?
I mean, those would be the key players. I mean, you should have a financial coach, accountant. You should have an attorney that's going to structure things for you, to be able to, I mean, you create the wealth, but how are you going to pass the wealth? You know, that's an important issue. And then the attorney and setting up trust. And then you also need that team, because, you know, what I found is a lot of people will YouTube stuff and get the wrong information. And that's the worst thing you can do. There's a lot of self-help type stuff. You know, I've been in the investment business for a while, and when the Fidelities and the Vanguards came into place, people were self-directed their investments without any financial coaching. So you go in, you say, I made 70%, but not really understanding the market. Just like with Bitcoin. Excuse me, people will buy it and don't understand it because they listen to everyone that says I've made money, but they don't know. I mean, if you're going to invest in the company, learn to read a financial statement, you know, learn who the management team is. So you're truly investing and you're not speculating. In the tax industry, the biggest thing is people are pushed, what's my refund? And that shouldn't be the strategy. I mean, you should get less of a refund, but then utilize your 401k, because then you can build assets in the 401k as opposed to, or you have more money in your paycheck that now you can put the use to build wealth. But the whole industry is based on getting a refund. But you should be working on how best you can maximize your paycheck. And that's where the W-4 management comes into place. And then utilizing the components of your paycheck. There's a book out there a few years ago, it's called The Automatic Millionaire. And he talks about using the 401k to build wealth because everything comes out automatically. You set up a mutual fund account, take $50 automatically from your bank account. That's how you purely develop wealth strategy.
Yep. The other thing I'm thinking about is it's not just one part, like you were mentioning. People look for the return, but the other part of that is the tax implications.
Right.
So now, as we look to, there are those of us of a certain age where we're starting to get a little excited about retiring. The challenge is, if you truly retire and step off from work, now what you have is all you have. Mm-hmm. And Social Security, you know, you keep hearing they're going to cut, they're not going to cut, whatever. Assume they're going to cut. All right, so assume that. And then you got to worry about the, you know, your principal, the balance of what you have and how long you're going to live. Now, I personally am living until I'm 250, so I need a lot of money. I'm just saying. And I need that money to work for me. But as it works for me, I need to understand the tax implications for when I want to pull it out. And that's why you can't have just one of these entities. You need to have them all talking to each other so that the financial advisor can maximize your return, and the accountant, he can collaborate on, all right, based on what you got, this is what you want to pull out. These are the tax implications. Here's how we mitigate those implications. All the while, the attorney is building your estate plan so that as we move on to glory, you want to preserve all the wealth and minimize what's owed to the government and other parties, and you want to protect that. So it is important that we plug into not just any resource, but the right resource, that we collaborate, that we understand why we're doing what we're doing, how we're doing. And thank you for being a key part of helping us to appreciate and understand what's available, the implications of our actions. And I'm gonna give you an opportunity to talk about you. Like we see you got your visual up there. Talk about what you do, how people can reach you, where you're certified, all that stuff. Go ahead.
Herman, before Ron says tell us about him, I've got one last question. As a counselor, we work with clients at various income levels, and a lot of individuals are self-employed and they report their income, and that affects their ability to be able to achieve home ownership. And that's a problem, particularly those individuals that, well, it doesn't matter, whatever type of income, self-employed, they report their income and they under report. how can someone, because a lot of these individuals still want to achieve home ownership, how can someone get how can they report that income at a later date, showing that they have made the income? And I guess that's it, that they have made the income.
Well, I think the first strategy is to be aware that you have to pay taxes.
Yeah.
Because I think a lot of times the strategy is I'm going to reduce my income so I don't have to pay taxes. And
Correct.
the first premonition is that I'm going to pay taxes. So with that being in mind, so every dollar you make, put aside 20% to pay taxes. I mean, that's the first strategy. Now, there are some other strategies where you can set up a deferred compensation plan, defer income, not realizing that. You know, that's some complex training. But I think the mindset has to shift that, you know, I'm going to pay taxes, and how best am I going to manage the tax management process? I think that's the key, because the thing is, the less you, of course, the less that you have as a profit, the less you're going to pay. Also, just simple strategy, you're self-employed, you're an LLC, single member, consider shifting to become an S corp. That will save you in taxes. Just knowing those different techniques will be beneficial.
Yeah. Thank you so much. This has been great. Thank you.
Thank you.
So tell us about you.
Yeah, my name is Ron. I been in this business 38 years, been a registered representative, been a registered manager, been a VP in this industry. And one of the things that I've always seen being in this industry is that, particularly in our community, we're not educated on the financial literacy piece. And sometimes we're always late to the game. So my mission when I formed Philadelphia Financial Consultants, I saw that, we weren't getting the piece of the literacy. So I started going into the schools, teaching the younger generation about investing, and just overall community, going out creating workshops to just educate folks. And as a part of that, I was affiliated with some major companies. I made the decision about 5 years ago that I would go independent, because in a lot of cases, what I was finding, some of the major companies, they say they'll come out, they'll help the community, but it's all profit driven. So my mission was to not so less. Of course, I got to make a living, but it's not profit driven. It's the ability to come back and help the community create wealth, and also be able to speak to you the way that I can, as opposed to having to, if I was with a major company, I got a compliance generated script that I got to say certain things. But as running my own company, I can be frank with you. I can tell you the real deal. And that's been my mission. And, in the real world, I've received honors for production, sales production, been at the top of the list in many cases. I started my tax practice. I was going to buy Liberty Tax franchise, and I spent a week there, and I just saw, the whole mission is to, at the time, to do rapid refunds, and, people coming in and they get a refund and paying exorbitant amounts of money. And I was always getting in trouble. I would say, well, why don't you just put the money in your bank account, wait a week from now, you'll get 100% of your money, as opposed to paying a $500 fee. So I backed out on doing that deal, and I set up my own tax preparation component, and just about helping people. So I work pretty much on a scale. You come in and I have a flat fee, or I have a fee that I charge. And if someone says, well, I'm a little tight on my dollars, I'll say, hey, I'll work with you. So, I just want to make sure that things are done right and in the proper order. That's pretty much my story.
Ron, where are you available? I'm speaking in North Carolina later this month. Do you go outside of Philadelphia?
Yes, you have a ticket, we'll travel.
Okay.
Well, I do a lot of stuff virtually. We have a financial minister at E9, and we actually had some folks from Africa join us a couple of times. So
That's great. Thank you so much. So I can
I mean,
keep
if it's
your
virtual,
information in mind.
you know, if it's
Virtual
virtual,
works.
you know, just tap me, and you know, I'm glad to speak. Also, if you I have a local program here in Philadelphia. It's called Let's Talk Money. If you go on the YouTube and you type Ron Williford, Let's Talk Money, I've got some videos that I've done for my television program. I'm also blessed. I'm an identical twin. My brother happens to be an attorney, so we work together as a team. I always mention him because he's a part of my team. So with estate planning, you know, I walk my client up to the point where we're at the point where they need to do estate planning. Then I shift and hand it off to my brother, and he actually prepares the documents for me. So we work as a team, and we were raised to help people, and that's a part of my mission, is to be of help. And, you know, I always hear you should charge more, and that's not the way as they say, that's not the way that I roll.
Well, you definitely have helped us, and we certainly appreciate your insight. Again, can you give us the details of your show? How do we see it on YouTube?
Yeah, it's if you Google Ron Williford, Let's Talk Money.
Okay.
It should,
All right.
the show should pop up. It's on a local cable network. And then the other thing, I'd like to thank Reverend Murphy. He's actually my college roommate. So I remember those days that we were 18 years old and talking about how we would impact the world. So this is where we are.
Indeedy, and it's due Brother Murphy that I was exposed to you, and I'm so grateful that we did. So thank you.
Oh, you're much appreciated.
Nah, we got more. Hold up, we got some more, because one thing we want to do is connect people with the resources. So I'm going to ask Eric, can you go to the next slide, please? All right, this is an overview of the calendar of events that we got. So we've had, as I mentioned, on February 16th, we talked wills and estate planning. This evening, March 9th, we got tax prep. We're going to have another wills and estate planning event, but that's kind of a private affair. It's restricted to Diversified Resource Network. Cora, do you want to say some more about that? That's Cora. That's the organization that Cora heads.
Well, I'm so excited about the information that's being shared, and that's going to be a great event. If you're with a local nonprofit, we would encourage you to sign up, and we'll make the link to that particular class available to anyone that's with a nonprofit. So we're willing to share. So that's what it's all about. Thank you.
Absolutely.
Hama.
Oh, thank you. And on March 13th, this is the college season. A lot of people are getting some letters saying, we want you to come study with us. And studying oftentimes, or very few times, not free. So you're going to have to take student loans. So we have our colleague, works here at the National Foundation for Credit Counseling, Barry Coleman, very knowledgeable subject matter expert about student loans. He's going to present this information that I think a lot of people are going to be interested in at a very timely point in the calendar. And then we've got on May 11th, a subject matter expert from Wells Fargo, Rulon, Washington, who's going to talk about foreclosure and eviction prevention. We all know about the pandemic. We all know that people suffered economic loss due to loss of job or reduction in hours. And as a result, the ripple effect has resulted in, the ripple effect has resulted in some people having financial hardships that put them at risk of losing their home. So Rulon is going to provide us insight on how we can manage that situation to a better outcome. And then we're going to have an insurance overview. Now, here's the thing. Some people treat insurance like it's a bonanza, and that's not the purpose. The purpose is to basically replace lost income or to avoid financial tragedy. And my challenge is, you know, there's term, there's universal, there's variable, there's whole. You know what? It's jargon. Just break it down for me. Tell me like I'm in 5th grade so I can make an informed decision and make the right decision for me. So that's what Eugene's going to tell us on June 8th. And then you see the rest of them here. We're also working on getting some additional presentations scheduled. We're looking at the CFPB to come in and talk about the small business resource they have available. We think about it from a personal financial standpoint, not so much about the business part. They're going to talk about the business part if I can get them. And then the small, well, I'll hold off on that until we can see if that can happen. But we got more coming. And so please be on the lookout. Next slide, please, Eric. There may be somebody here who's interested in joining the Faith-Based Alliance. Wanted to give you the resources that you could contact us. You see my email there, hpalmer@nfcc.org, or my colleague, Pam Carter, pcarter@nfcc.org. So please don't be shy. Send us the information. Next slide, please. There may be people who need counseling resources themselves, or you may know of someone who needs counseling resources. These are the areas that we counsel. Call this number. It's confidential. Don't worry about being shamed. Don't worry about being judged. Just get connected to the help that you need. We're giving you the number and the link so you can dial in, get connected to an agency in your area. This applies nationwide. So don't be shy, don't be shamed. Next slide, please. All right. Again, this is not just about us promoting the NFCC. We want to get you connected to those resources that can help you in whatever challenge you are facing. So you see, you got us, we've got our sister organization we'll call Freddie Mac. They're there. We got our other sister organization, Diversified Resource Network. We've got HUD. We've got the FTC. So these are resources that are well known, that are vetted, certified, and trustworthy. If you have a need, don't sit in the house in the dark, rocking, praying for a solution. These can lead to the solutions that you need that will help you so that you can come out in the daylight and enjoy life. Next slide, please. More resources. We're not playing with your ticket money. We're trying to connect you to help. So here we go. Avoiding financial traps, beware scams, protection for older adults, Fannie Mae, child identity theft. All these resources have been researched and identified and posted here for your benefit. All right. What's the next slide? This is more stuff about us. All right. We got any more slides there? Okay, look at us. Hey. So I wanna, Ron, I wanna thank you so much for being the subject matter expert to speak this evening. Thank you for breaking it down and making it so that we can understand it. Thank you just for all the good work that you do. I want to recognize our sponsors. That's Freddie Mac, that's the Wells Fargo Foundation, that's TD Bank. I would like to review the recording. If you want to review tonight's recording, we're going to make that available. Please do not leave without first connecting to our survey. You can access it through the link in, is it the Q&A box, Eric? We're going to put a link up there. It's a very quick survey, no more than 7 questions, couple of keystrokes and you're done. I want to thank my colleagues and co-hosts. You know, they keep me, it's not an easy job, but they reel me in and they keep me centered. And I'm gonna give them an opportunity to say a couple words before we check out. So, all right, we're gonna start with Cora and we can get to LaTanya.
Thank you so much, Herman. I'd just like to say thank you for tonight's presentation, Ron. I really got a lot out of it, and thank you again for sharing with us. LaTanya?
Thank you so much to everyone. Cora, Herman, Ron, thank you for the list of all the people we should have in our arsenal as we are thinking about wealth. Ron, thank you for saying that you are open to looking at people's incomes and, perhaps on a sliding scale so that they can afford your services, because a lot of times people do not come to the table because they don't think they have enough money, and they believe that advisement is only for the wealthy. And like you said, that is what is keeping us behind. So thank you so much on behalf of Freddie Mac for letting us partake in this tonight. And I think that, thank you. Do we have Pastor Jones on tonight? Were we able to have him join us? I'm checking.
Okay, I know we had some technical issues. I know Associate Pastor Kevin Murphy was not able to, he had a conflict in his calendar, but he certainly sends his regards. And Pastor Cedric Jones, one of our
is in the meeting, and if he'd like to unmute his microphone, if he's able to, and say a few words, please do.
Because we could not bring this to you without both of these pastors.
Absolutely.
So I just want to thank them both. Enon, they have a gem in you, Ron.
Absolutely.
Yes.
Well, Herman, I think we should have you close it out.
Well, I will say it has been an honor and a privilege to work with such fantastic people. I get the benefit and the blessing of working with Cora, with LaTanya, with Kevin, with Cedric on a regular. And Ron, brother, you stuck with me. All right. You came in, you showed up, and you showed out. So thank you so much. I really want people to take to heart what this is about. This is about connecting people with the resources that we dream about. I can't tell you how many times in my family, I would hear people say, if we could only do X.
Yeah.
This is about helping you to do X, Y, and Z so you can master the ABCs of wealth creation, of building it, preserving it, and then passing it on. Everybody deserves a good life. Everybody deserves the very best life. God puts the seeds of potential in each and every one of us, and it falls to us to try to do everything we can to bring out the greatness that he's put in us. So please take advantage of these resources that we're making available. I ask that you enjoy your life. Take your time, know that you deserve it. And I thank you for taking the time to join us. You could have done any one of 1,000 things, but you chose to share your time with us. So thank you. Have a wonderful evening, and I hope to see you again soon. Take care.